wonder, how'd that work out for me? The answer is I'm not sure yet. But Terry Sawchuk sure was right when he told us here a couple of years ago that things were going to change a lot. More in the next 10 years than they have in the last 10,000. Terry Sawchuk is the founder of Sawchuk Wealth. Joining me here on the program again. Terry, good to see you.
Steve, good morning.
To have you, my friend. Look, things are changing fast, and it's hard to keep up for people. And I'm not just talking about the economy. I'm talking about China's building up the military and whatever's going on with the war in Ukraine and things everywhere. Just chaos everywhere. And the CDC telling us that we have to jab our children with an mRNA vaccine that nobody trusts and would put into their kid knowingly. Now they're going to try to make it mandatory. I mean, there's just crazy stuff going on. But we're going to focus on the markets here today because that's your area of specialty, of course. And I want to talk about this strong U.S. dollar. I think a lot of people don't understand that exactly. I don't know that I understand it as well as I should. A strong dollar, a weak dollar, what does it mean? And what's happening in Europe right now that's got your attention?
Well, the strong dollar is happening primarily because the Federal Reserve has taken such aggressive actions to get inflation under control, right? So by aggressively raising interest rates and more importantly, sucking dollar liquidity out of the system, that's really what the big problem is. So when you look at global trade, US dollars are basically involved in 90% of all global trade. And so the fact that the dollar has gotten so strong, it's wreaking havoc on other countries. So there's been an interesting development, Steve, in the European central banking that I think we should talk about.
All right, let's talk about that because, there's havoc going on in the UK. The second prime minister in what, 2 months, resigning. Just a mess over there right now. And a lot of that has to do with banking and the economy and everything else as well. What's going on?
Well, there's been sort of an interesting development in a sense that the swap lines through the Swiss National Bank have started to become used again. Okay, what that means is that banks are going to the Swiss National Bank to get U.S. dollars in lieu of trading amongst themselves. And normally they have auctions. Nobody shows up for the auctions because all the business is done between banks. But in the last few weeks, as many as 15 banks have now showed up at these auctions. And what that means is that they don't trust the lending amongst each other anymore because they're afraid if they trade with another commercial bank, they might not get paid back. Now, this sounds wonkish, and it is, but these are signs of global stress. And the last time we experienced anything like this was the 2007-8 global financial crisis, and then again in COVID in 2020. So we're not to the point yet where it's going to collapse, but we are seeing some signs of stress.
You said on this program a number of times now, your clients, you began pulling them back into cash months ago at the beginning of the year.
January.
You began pulling them back, sheltering them from any possible storm. So here's my question, because you say a collapse could come. Would you take people to cash now? Would you not take people I don't know. And I don't want you to give any financial advice exactly, because I know what the disclaimer is. You don't invest in anything you can't afford to lose, all of that stuff. I'm just asking for, what does it mean? Does it mean we could, if we saw a collapse today, would it be worse, you think, than 2008? Worse than what we saw at the front end of the pandemic? What do you think?
I don't think it's worse than 2008. I think, especially in the United States, the Federal Reserve and the banking system has taken some pretty meaningful steps to prevent something like that from happening again. Where I think we're seeing some stresses in the Treasury market, and part of that is just because rates have gone so high so fast that people don't want to buy anything other than 1 to 3 month treasuries because they know in another few months the rates are going to likely be higher still. That will level out at some point. As far as, look, I still, Steve, we've talked about this a fair amount. I still think the S&P 500 is going to go down and test 32 to 3,400. We'll see if it holds. Okay. So from here to there, it's another 10 to 15%. So it doesn't hurt to raise some cash even here. I know the market's down quite a bit. If you look at the math, the S&P is down over 24%, NASDAQ's down over 34% just since January. But I think there's another 10, maybe even 20% before this thing bottoms out. So holding some cash right now, it's not a bad idea. It'll give you some dry powder. Number one, you'll avoid whatever next leg down there might be. Plus, you'll have money that didn't go down that you can buy back in and get some great value. So, conceptually, there's nothing wrong with raising some cash right now.
I see. So, uh, when you look at different factors here, because you see commodities being pushed all the time. Gold today, 1641, down from a high of what, 2200. Here's my question: if the dollar goes from being a strong dollar to a weak dollar, what does that do to commodity values like gold? Doesn't it push it straight up, or am I looking at it wrong?
No, typically there's an inverse relationship between the strength of the dollar and equities and commodities and other things. So, it would likely be a good move to start looking at equities and commodities when the dollar transitions, and it will. Okay, we're just not there yet. The dollar is likely to continue to strengthen for a while, mainly because there's so much trouble in Europe. And ironically, Steve, this is kind of political, but it's become pretty clear to me that Joe Biden and the administration wanted Putin to invade Ukraine. Look at all of the natural gas that Europe is buying from the United States right now. It's the same thing, Steve. I'll say the same thing on the stupid vaccines for 6 months old now. You have to follow the money, right? The reason, as I understand it, I'm not an expert in this, but the reason that they wanted that vaccine for 6 months old to whatever the ages are is because it protects the drug companies from liability. They become legally immune to the side effects of these vaccines if they.
That's right. They become
Yeah,
inoculated against lawsuits as a result. You're exactly right.
follow the
But
damn money.
let me ask you about, speaking of following the money, back to the United States dollar, the U.S. dollar being the world reserve currency. There is
Mhm.
an effort by China, Russia, even India now, an ally of ours, but creating a different reserve currency. This is a conversation that is happening. What would happen to
Yeah.
America if we were no longer the reserve currency? If they created a currency, whatever it might be, or used one of the existing currencies in Asia as a reserve currency, what would happen to the U.S.?
Listen, I think it's not going to be the dollar is suddenly going to be supplanted as the world's reserve currency. Over time, it may diversify, right? So some more of that trade might be taking place in currencies other than US dollars, whether it's rubles or renminbi or whatever. So look, at some point it will lose some of its status, but it's not going to get replaced anytime soon.
All right. Terry Sawchuk, a wealth of information, watching Europe. We'll see how they play out if their banks, if they make their way through. Sawchuk Wealth, you can find him online right there. Sawchuk Wealth, you can find him online. Terry, thank you for being here as always.
Have an awesome weekend, buddy.
You too, my friend. There you have it.
Any information I discuss in this article is for educational purposes only. It is not meant to be any kind of recommendation or financial advice. The information contained in this video is intended for informational purposes only. Any opinions are those of myself and not necessarily those of J.W. Cole Financial, Inc. or J.W. Cole Advisors, Inc.